Have you ever heard the term hedge fund and wondered what it actually means? In the world of finance, hedge funds are often talked about, but the purpose and workings can be a bit mysterious. Today, we'll demystify hedge funds and explain them in a simple and beginner-friendly way. In simple terms, a hedge fund is when wealthy people pool their money together and give it to a singular entity to invest and grow on their behalf. Hedge funds originated in the mid-20th century as investment vehicles designed to provide wealthy individuals and institutional investors with an alternative investment strategy. The term hedge originally referred to the practice of using investment techniques to mitigate or hedge against market risks. Hedge funds were initially created to hedge their positions by employing various strategies to protect investors' capital during market downturns. These strategies included short selling, derivatives, leverage, and other advanced investment techniques. The goal of hedge funds was to generate positive returns regardless of market conditions by taking advantage of both upward and downward price movements. The flexibility and agility of hedge funds allowed them to pursue opportunities across different asset classes, including stocks, bonds, commodities, and currencies. Over time, hedge funds evolved and expanded their strategies beyond traditional hedging techniques. Today, they encompass a wide range of investment styles, including long-short equity, global macro, event-driven, and quantitative strategies. While the primary objective remains generating significant returns, the risk profile of hedge funds can vary depending on their specific investment approach. Unlike mutual funds or ETFs, hedge funds are typically available only to accredited investors. What is an accredited investor, I hear you asking? Simply put, an accredited investor is an individual or institution that meets specific criteria set by financial regulatory bodies. Accredited investors are deemed to have a higher level of financial sophistication and therefore have access to certain investment opportunities that are not available to the general public. To become an accredited investor in the United States, individuals must meet specific criteria outlined by the Securities and Exchange Commission. The most common ways to qualify as an accredited investor are based on income or net worth. To qualify based on income, an individual must have earned an income of at least $200,000 in each of the past 2 years, or $300,000 for married couples, and have a reasonable expectation of reaching the same income level in the current year. To qualify based on net worth, an individual's net worth, excluding the value of their primary residence, must exceed $1 million, either individually or jointly with a spouse. In addition to these criteria, certain entities, such as banks, insurance companies, and registered investment companies, also qualify as accredited investors. Hedge funds often focus on diversification, which means spreading investments across different asset classes and markets. This diversification helps manage risk by reducing the impact of any single investment's performance on the overall portfolio. Additionally, hedge funds may use risk management techniques such as hedging or employing derivatives to mitigate potential losses. Hedge funds typically have a unique fee structure compared to traditional investment funds. They often charge a management fee, which is a percentage of the total assets under management, and a performance fee, also known as a carried interest, which is a portion of the profits generated by the fund. This compensation structure aligns the interests of the fund managers with those of the investors. Hedge funds are subject to certain regulatory requirements, although they generally have more flexibility and fewer restrictions compared to other traditional investment vehicles. Regulatory bodies, such as the Securities and Exchange Commission in the United States, oversee the activities of hedge funds to protect investors and maintain market integrity. Hedge funds can offer potential benefits, such as the possibility of higher returns and access to unique investment opportunities. However, it's important to understand that hedge funds also carry risks. These risks can include market volatility, liquidity constraints, and the potential for losses. Due to their complex nature, investing in hedge funds requires careful consideration and often professional advice. In summary, hedge funds are investment vehicles that aim to generate higher returns than traditional funds by utilizing various strategies and investment techniques. While they can offer unique opportunities and potential benefits, they also come with risks. If you're considering investing in a hedge fund, it's crucial to thoroughly research and understand the fund's strategy, track record, and associated fees. Thank you for watching. If you found this video helpful, don't forget to like and subscribe to our channel for more simplified finance explanations and insights.